a lot of what's happening with AI in the last, 6 months to 2 years is that the cost to build a first version of a software product has just continually gone down in price. So, that was tens of millions of dollars in the 1980s. It's probably down to, $1 million in 2010. And by the time you got to the late 2010s, if you're a technical team for a lot of business models, even high ticket enterprise SaaS ones, it was close to zero. It was just your labor. And so now you can build incredibly sophisticated products very quickly with relatively low cost. So while you can go back from the 80s to late 2010s, and it's always gotten cheaper to build the first version of your product, it's never really gotten much cheaper to scale. The biggest change we've seen with these young companies internally is using AI tools from the very get-go when you're a young company, and the extent to which people can scale with so much less labor in the last few years than it would have taken in the 2000s. And that's just incredible. In today's world, you don't just identify or help a human do something. Your software product has to have the ability to do the full execution. And you can have a human in the loop in the middle, and maybe the software has to say, hey, and ask permission or says, here's what I'm going to do. And the human can say yes. But it's that full execution that is the real opportunity. And that's delivering value beyond anything that software's been able to do before.
Dave, good morning. Welcome to Innovators Inside.
Hey, Ian, thanks for having me here.
Yeah, it's super exciting to have you. I can't wait for this conversation. I think we're going to cover a wide range of topics, but centered around your perspective at the front end of kind of the venture capital markets. And boy, I just want to dive in. But for folks who don't know you, I just want to say welcome to Dave Lambert, founder and managing director at Right Side Capital Management. We almost share a block and a neighborhood in San Francisco, but this is how we get to meet on a podcast. So thanks for coming on. I can't wait for the conversation.
Yeah, lots of exciting stuff to talk about these days. That's for sure.
Let's just start by grounding the audience in a little bit of your background. You have a fascinating background in early stage investing in data-driven decision making. Can you just kind of give us a little bit of what you do and how you came to be sitting here today?
Yeah. So just the 20-second, Dave Lambert background. I went to school in the Bay Area, Stanford, graduated in 1992. And for most of the 90s and 2000s, I founded and was the CEO of two technology companies. One was a hardware company in the 90s to early 2000s. One was a software company in the 2000s. And then along with my two other co-founders, we founded Right Side Capital. We started working on it in 2009, and we went live in 2012. And we would describe ourselves as a quantitative, data-driven approach to what we call pre-VC stage investing. And basically, we make very quick yes/no decisions. We build ultra-diversified portfolios where each of our funds has many hundreds of portfolio companies in it. And the companies that we invest in are companies that are raising small round sizes. So we're typically investing in anywhere from $150,000 to $500,000 total round sizes. And in today's world, we're usually anywhere from $150,000 to $400,000 check into those. And we've been doing this since 2012. We have well over 2,000 portfolio companies. And so we get this interesting seat at the very front end of sort of the capital efficient frontier of the entrepreneurial tech ecosystem. And then we get to see those grow over time and work with these companies as, lots go to zero and then lots become worth tens of millions, hundreds of millions, and billions of dollars along the way.
So setting aside everything else, let's just talk about what a fascinating data set that you've got in front of you. And actually two data sets. You've got the data set of more than 2,000 companies that you've chosen to invest in. And then obviously the many, many more that you've looked at but haven't been able to get conviction on. We talk a lot, I think, in today's world about just how fast things are changing, about how hard it is to make decisions. We're going to get there in a second. But let's talk about what's not changing to start. Like, what kind of patterns have you seen in the companies that you have chosen to invest in that still hold true today?
Well, basically, a lot of what's happening with AI in the last 6 months to 2 years is partially an extension of a trend that's just been playing out over multiple decades, and it was playing out really strongly in the 2010s. And that is that the cost to build a first version of a software product has just continually gone down in price. So, that was tens of millions of dollars in the 1980s. it's probably down to, $1 million in 2010. And by the time you got to the late 2010s, if you're a technical team for a lot of business models, even high ticket enterprise SaaS ones, it was close to zero. It was just your labor, right? And I think that's what's happened with the increase in the sophistication and capabilities of AI tools is it's just turbocharged that even more. And so now you can build incredibly sophisticated products very quickly with relatively low cost. So that trend hasn't changed, and it's been an extension of that. One thing that's really interesting that's been a change that we've never seen before, but we've seen in the last 2 to 3 years, is on the operational side. So while you can go back from the 80s to late 2010s, and it's always gotten cheaper to build the first version of your product, it's never really gotten much cheaper to scale from there on out. Like marketing, sales, customer service, and support, stayed the same or sometimes gotten more expensive. But the biggest change we've seen with these young companies internally is using AI tools from the very get-go when you're a young company, and the extent to which people can scale with so much less labor in the last few years than it would have taken in the 2000s. And that's just incredible.
Well, it is really fascinating because I had a conversation with a guest on a previous episode trying to actually ask the question, are there even any AI native companies that exist yet in the world? And I think maybe we'll get there, but you're heading that direction. You're basically saying, hey, maybe there's an inflection point where it's not just the product size or the cost of development asymptotically approaching zero, but potentially the cost to scale. And that has implications for all kinds of things, structure, operations, et cetera. Is that actually something you're seeing in your portfolio?
Yeah, structure, operations, even how much capital a lot of these companies are going to need to raise over time. So one of the interesting things, if you sort of look forward in time, there are going to be, companies in the AI space that are going to require massive amounts of dollars and go down the large venture capital path and into private equity. But I think there's going to be this large spectrum of the tech entrepreneurial ecosystem, that this huge profile that might be this middle 70 or 80% that in the 2010s and early 2020s all needed a fair amount of capital to get to a point where you're profitable with sustainable growth. And I think the amount of capital that's going to be needed is going to be substantially less potentially coming up, certainly to build the product and for customer service and support. And that's going to have some implications for the venture capital world and private equity world, definitely.
Definitely is. We might save that for later in the conversation because they could be existential in some cases. Um, but I am curious. I'm really curious about the patterns that you are starting to see emerge that are maybe new, that you're seeing emerge over the last 2 years, 3 years, maybe even 6 months. And in particular, what are the signals that are starting to emerge that you treat as investment signals that maybe you didn't even see or think about a couple of years ago? Is AI changing something very fundamental from an investment thesis perspective for you?
Yeah, at the early end. And again, if you take sort of my initial description of who we are and what we do, and we have this sort of seat and window at this sort of capital efficient entrepreneurial frontier in the tech ecosystem, what that looks like has changed so dramatically, not just in the last 2 years, but I think even in the last 6 months. So the profile, I would say, from the beginning of this year, even just say January, February, and beyond, of what a company looks like that's reaching out to us for funding. And remember, like we get almost unlimited outreach. So what I'm talking about, what's the cream of the crop look like? It's so substantially different now than it was even just a year ago. And what I mean is that companies have more revenue than we've ever seen for the round sizes that we're deploying at. They have faster growth than we've seen. So like a company, 3 years ago, if we saw a company and they had 20K MRR, like that's great
Not
for
bad.
us. And
Yeah.
maybe they've been around for 2 years to build the product and do that. And now we see companies that have substantially more than that. And maybe they just launched 4 months ago, right? 5 months ago. This was just almost impossible, like even just a year or two ago. And it's not just that, but some of the price points are higher, and some of the speed with which they're able to engage with some large companies. I think there was this interesting shift that happened in the mid 2010s, and I think that a similar shift's happening now, which is that when we started investing at first, most of what we invested was B2C because it was harder to build a sophisticated B2B product with not much money, but even more so, mid to large size companies wouldn't engage with startups. Like, you'd risk losing your job if you bought a product from a startup and then it didn't work out. You're worried you're going to get fired. And somewhere between, say, that 2013 mindset and 2018, the corporate world became comfortable engaging with startups and buying products and realized that the world doesn't come to an end. And I think that same thing's happening now, which is that it's amazing for us to see the size of the customers that some of these people are working with. And this company's only been around for 4 or 5 months. And that's because they've built these agentic products that provide so much value and do things that no software could have ever done before. And there's this mind shift and mind change in the corporate world that it's okay to engage with these raw companies, and we almost need to stay relevant. And that's something that I don't think we saw a year or two ago, but we're just seeing now in the last few months.
Thinking back to like the cloud migration era, right, to date myself, I don't think we saw customers view the technological shift as an existential threat in the way that they seem to be thinking now. But it is interesting because a lot of those early uh, POCs, those early revenue traction engagements with corporations aren't actually going to lead anywhere, at least in my experience. They're going to lead to, something that's going to fail, get shut down, et cetera. It's not going to work out. A lot of them are very experimental. Is that what you're seeing, or are you actually seeing true, repeatable, defensible ARR, MRR that is scaling quickly?
Yeah. So, I mean, two questions there.
Yeah.
Defensible meaning, is it defensible against, foundational AI model improvements over the next 3 years? That's a harder question to
That's a
know and
whole other
understand and
question.
everything. But are we seeing ones where, yeah, that some of these companies are engaging and there's some usage-based pricing and they started at this level, and 3 months later, companies are purposefully using it more and paying more? Well, that's very different than, all right, I've just paid you $10,000 for a 90-day trial and let's see what happens. And maybe I like it or not. And even if I like it, it might take 6 months to get to a contract after that. You know, some of these agentic products, companies are seeing it and doubling down much more quickly and being willing to grow and become larger customers. And that's the part that I
That's
just,
exciting.
the values there, the math's almost too compelling to ignore sometimes on
Yeah.
these. And I just don't think it was hard for a startup to ever have that compelling of a offering, balanced against the risk of working with this raw startup. That was always, always, weighed heavily
How's
on the
your
scale.
decision making? How's your decision making shifting? Are you looking more toward the commercial side in your decision making? Because look, I got to tell you, I mean, at this point, this is almost a trope, but like 2 years ago, I threw up my hands and said, I have absolutely no idea how to invest in AI. And so I backed off and I looked at some of the fundamentals. How are you making your investment decisions, and how has that been changing over the past 6 to 20 months?
Yeah, it's very hard and it's changing, ask me every 3 months and it's slightly different what we're looking at and doing. In today's world, we will still invest in pure software companies, which some investors won't. But in general, we have a bias towards, we don't want to invest in what people traditionally think is software, which is that software helps manage a workflow, that allows a human to do that workflow more efficiently. And the new, you really have to not just assist in a workflow. To be really impactful, you have to execute. You don't just identify or help a human do something. Your software product has to have the ability to do the full execution. And you can have a human in the loop in the middle, and maybe the software has to say, hey, and ask permission or says, here's what I'm going to do, and the human can say yes. But it's that full execution that is the real opportunity, and that's delivering value beyond anything that software's been able to do before. And part of that is because these agentic solutions can sometimes execute across multiple areas of an organization in a way that a human couldn't, or it's just able to do stuff and replace humans. And you're not selling against another software product that can do that right now. We're in this Goldilocks period where you're just selling against the human labor as your what you're selling against, and you just crush that. So it's really interesting.
It seems that you're making some very clear bets though on how the human side of the customer is going to adopt technology, right? Like, I mean, setting aside getting into conversations about labor replacement and job displacement and all of that interesting stuff, um, there is a difference between a set of AI tools that gives a human superpowers. As you said, they help them do their job better, and a system that can work on behalf or instead of humans and do things that humans can't do. Those are fundamentally different things. It seems to me that you are betting that organizations, customers, and perhaps society writ large are going to be prepared to accept real intelligence, real automation, real agentic work in the coming years.
Yeah, I think they are. And I think what happens is that it's there once you do a pilot or proof of concept and you see it and see that value, it's hard to not want to keep that in certain situations. So, and some of this we see in new things, products that are created in companies coming to us. Some of it we see in existing companies and what they've pivoted to. Like maybe an example of an existing company of ours. They were a SaaS product for independent hotel operators, and it sort of ran the whole operations of a hotel. And then they sort of rebuilt their whole product AI first, so a lot of agentic stuff going on internally, and then they started making agents available for the hotels. But it's not just things that you might think of, like, all right, customer service, and we can respond to guest text and all of this. It's all right, now you have it so that this hotel operator can come in and they can have that agent tell them here in June, I see I don't know what the proper terminology is, but I see that our booking backlog for October and November is a little lower than it's traditionally been in past years. Do you want me to go out, and my suggestion is that we spend X amount and we do this over this period of time, and that should cover the shortfall. Do you want me to handle that for you? And the human can say yes. And then that agent goes out, does all of the marketing buys and does it. And so basically from that customer's perspective, they're buying a solution.
Yeah, well, they're buying capabilities they literally, they may not have had and certainly couldn't have had at quality.
They may not have even known how to do it before, and they're ultimately buying that, and in some ways they're buying an outcome. Like if they're like, hey, I'm buying a more booked up hotel and better unit economics for my business. Like that's what when you start getting to like the mid-size down to SMB space, I think that's the mindset of the purchaser there. And some of them are going to want the human in the loop where the agent asks first, and some of them after using it for a bit are going to say, hey, I trust you. You don't even need to ask me anymore. You can just go identify the problem and spend up to this amount and just let me know after the fact. These are the transitions where we're at. And it's really interesting to see them play out. One of the things that's crazy is that humans embrace technological change so much easier than humans think they do in human society and race, in our race as a whole.
Humans go from magic to sci-fi to that's cool to mundane unbelievably quickly. I mean, all you have to do is look at Waymo. Like, we have self-driving cars. We have self-driving cars. And yet, okay. Yeah. It's actually kind of depressing to me, if we're being honest.
Yeah, exactly. In San Francisco, it's like, oh, I saw 12 of them on the way into the office today. Like it goes from super novel to just accepted amazingly quickly. And I think that's going to happen in the AI space with agentic AI agents running loose in business models.
Yeah, that is an interesting framing. And I mean, I'm inclined to believe you and to agree. I do think that there are some very fundamental kind of psychological things we're maybe not thinking about in the adoption of AI. Things like, where does accountability lie? Things like, how do I derive sort of my sense of self-worth that may have been developed by leading a team of 40 people in my organization, or whatever it is that we have.
Yeah, these are all really interesting human questions, and it's not like this is going to all go super smoothly. There'll be mistakes made, there'll be security breaches, there'll be all this stuff, but trying to stop the trend is like trying to stop a wall of water that's moving down a canyon. It's going to get to the other side and there's nothing you can do. You're better off getting a surfboard and riding the wave. Yeah.
There you go. Yeah, figure out what shape you're going to be in at the end.
Yeah.
Um, well, let's talk about one of these other macro trends that you mentioned, and that's the notion of efficiency, right? So you talked about the cost of product development for the MVP, like asymptotically approaching zero here. That is playing out in the capital markets. I think I've seen capital efficiency is back in various headlines, despite the multi-$100 million mega seed rounds that occasionally show up. Um, but look, here's my question for you. What signals do you look for that actually indicate to you that a founding team is thinking properly about capital efficiency, right? Because it's not a check size thing in my mind. It's what is it though?
Well, I mean, for us, it's pretty simple because it's just what are you actually spending? Like it's how much money have you raised or has it taken to get to where your product functionality is and where your revenue is and the growth rate that you've had. It's one thing to go to have, you could be at 30K MRR and with some decent growth trajectory and you've raised $1.5 million to accomplish that. And it's very different if you're there and you've raised nothing or you've raised 80,000 from friends and family.
You don't look at spend allocation across back office growth, ops, engineering. Does any of that play into your thesis?
Not that much for us right now. It's more like, all right, how much capital is it taken to get to where you're at? What's your current monthly burn rate? What's your projected burn over that next year? And for us, what we care about most is not necessarily, all right, that you have to be massively capital efficient over the next 6 years of your life, but we're just participating in a small round, or more often than not, we're the only money coming in. We are the whole round, and we're not investing in a company if our 250K check is going to only give you 5 months of runway, we're not investing. We want there to be generally sort of 12 to 18 months of runway from in a not great scenario to get a round done. So like that, so we sort of have this artificial constraint called runway, and we're not willing to invest in crazy small amounts of runway. So now that doesn't mean that we sometimes don't invest in a company we think has 15 months of runway and it turns out that was only 8. That's going to happen. But
Sure. Yeah, we all get it wrong sometimes, but I think that is really interesting because you kind of laid out a benchmark, if you will, for early stage founders to think about, which is can I scale, but can I get into enterprise accounts if you're a B2B company? Can I get into that 30K MRR on, I mean, you just said 10 to 15K a month, right? Which is kind of wild by historical norms. Do you see this trend continuing? I mean, are we approaching a place where VC money isn't needed?
yeah, it's going to be forced on the entrepreneurial world because the reason why it's going to be forced is that it's so easy to build products. It used to be, if you went back 4 years ago, 14 years ago, there's this magic sort of invisible bar that existed in any given sector or industry, and there are a certain number of companies that had a product that worked well enough that it was over that bar. It had enough value that it added that those companies were in play to sort of win the market or be successful, and the ones that had the best sales and marketing execution above that bar won. And it was hard to get above that bar because engineering was the backlog. We're coming into a world now where engineering is no longer the backlog. It's going to be, you're going to have a lot more competitors out there with products that work well. It's going to be that operational execution and sort of branding and customer acquisition that are going to dominate. But it also means there's going to be that many more startups. And you are not going to be able to, I think, in a year or two, get pre-seed and seed rounds done with the level of traction that is required today. It's just going to be higher because there's going to be so many companies for investors to choose from. So you're going to have to figure out how to get to some pretty significant revenue numbers with relatively little raise, or you're not going to get rounds done. You're just going to die because the cream of the crop will figure it out.
Well, okay. Everything you're saying makes a ton of sense. Now the question is, how do I connect to the dots between that trend to capital efficiency in software and I'd say a little bit of a secular shift I'm seeing in VC toward things that are fundamentally expensive like hardware? I mean, you grew up in a world of hardware and PCs, right?
Yeah. So everything that I've been saying is sort of on the pure software side. I think what's happening is that if you look at the larger check writers, if you look at sort of larger, mid-size VC and above through to private equity. So people are investing in maybe standard Series A size rounds and beyond in private equity. Your business model is built off of companies that take more capital. And, I think that in general, that whole investor world, what we've seen in the last 4 or 6 months, they're afraid to invest in anything that's just software. And everyone's afraid of making an investment and looking really stupid just 12 to 24 months later, through increases of improvement in foundational AI models or some competitor
That's
coming out of
right.
the
You don't
woodwork.
even, you don't even get the fun timeline window anymore. You get some like generational shift. Yeah.
Yeah. I had an institutional P tell me, that like not too long ago, that he was talking to an investor, and the investor said, it used to take like 3 to 4 years to look stupid after making an investment, and now you can measure it in months, and that's really subconsciously on people's minds. And I think that a lot of business models that had fallen completely out of favor from 2018 to through 2025 are now back in favor. And these are business models such as, businesses that have a hardware component, tech-enabled services, marketplaces. These are all things that were viewed as less attractive because they either had lower margins or took larger amounts of capital to get up and get sustainable revenue. And in today's world, suddenly, those are really attractive. One is because they do need some capital, so investors can put money to work. But more importantly, AI can't do those. AI can't do the end service in the tech-enabled service, but it makes the tech-enabled part even more efficient, and maybe your margins are better. It can't do the hardware. It can build the software for the marketplace, but the value in a marketplace is the flywheel going on both sides and transactions flowing through. So those are all real defensible business models against continued AI evolution, and they benefit from it. And that's where a lot of the dollars are going right now because it's just safe.
Do you think that sort of natural shift to those quote unquote safer, which is a funny word in venture, but those quote unquote safer markets is masking some maybe a more underlying structural weakness in how we think about venture right now?
I think it's a move there really quickly right now because it's a fear, right? Fear of investing in what you have been investing in. But I do think if we look forward, uh, much in the way that I said, like, agentic software products that actually they have to actually do the execution, not just sort of not just help a human do it, are beginning to become the new norm. I think there's going to be a huge boom in tech enabled services because tech enabled services, that end service can't be delivered by AI usually. And you're going to have business models where to deliver this service at scale, this tech enabled service, you needed, X number of people and you had 35% gross margins. Well, maybe now, AI turbocharges that tech enabled business or service business model because that tech enabled part is so much more powerful. Maybe you can do that same delivery of service with half the people, and maybe you now have a business that has 55 to 60% gross margins instead of 35. And there, I think, going to be some enormous tech enabled service businesses that form and grow over the next 5 years.
But are they going to be able to capture the same market share that maybe current models expect? Because I wonder about the fragmentation of that could result from simply more builders having access to the tools that they need to build. And so could you end up in a much more fragmented market for these tech-enabled services?
Yeah, you definitely can. I think there's potential across the whole technology spectrum. There's going to be more fragmentation, I think, because there's going to be so many more solutions that are above that bar of the product works and it provides value. I think an interesting side effect of, if I had to guess where we're going, is that brand is going to matter so much more in the tech world than it ever has. Like, we in the tech world, it we haven't grown up in a universe where brand mattered that much. That was much more of, especially in B2B, that was much more of a consumer issue, product issue. And I think now, if you have a world where, hey, there's 38 other companies that sell a product that's potentially similar to mine or can do some of this stuff, where does the end customer decide where to buy? And a lot of that is just going to be branding. It's going to be who builds a brand, who navigates the AI search world better and having their results come up, who is great at customer acquisition. I think branding and marketing and customer acquisition is going to matter more than it ever has because it's going to be harder to differentiate based on product.
It is really interesting to look at parallels. Like, I don't know, while you're talking, for some reason, music just pops to mind, right? Like, there's an almost infinite supply of unbelievably talented musicians, right, within any slice of dice, but some manage to build the flywheel of brand that drives followership, that drives brand, et cetera, that actually differentiates them. Yeah. It's fascinating to apply that thought to, staid old enterprise sales.
Yeah, no, it's really interesting. I think there's going to be a multi-year adjustment period as far as like what are the most important skill sets to get from, a million ARR to 20 million, and what's going to matter, and those skill sets are going to be very different than what it took to do that in the 2010s.
I think it's inevitable, but it's obvious to say that this has implications for venture writ large. But one of the conversations I find myself having perhaps more frequently these days than I did in the past is very simple: is venture right for you at the very earliest stages of companies? Because I used to be able to kind of make a pretty clean delineation between like how much capital does it actually take to build what you want to build in your vision, and that's harder now. And I'm seeing more and more founders do the math and say, you know what, my cost to 5 million ARR is pretty low. Why would I give up half my company? Um, how's that playing out for you?
I mean, that could be a big positive. I think one of the challenges, that I've seen in the entrepreneurial world over the last many decades is entrepreneurs don't really understand what the implications are of taking venture capital. Like you're committing to sort of big growth or bust. You got to get to huge numbers. You can't. There's no small mid value exit sales that are allowed, and sometimes more often than not, it was just forced because companies needed so much capital to be able to generate revenue that they just had to raise those amounts. And I hope that there'll be more awareness amongst entrepreneurs, and as you can build stuff more efficiently and you don't necessarily need all those dollars, and it's sort of more optional, that people will start to become more aware of what are the implications. Like if you want to be able to sell for 50 to $100 million, you should not be raising from professional venture capital firms generally.
100% true. Well, actually, on that point, though, how is Right Said Capital thinking about not just, you said often we're the only check in around. What if you're the only round?
Yeah, that's fine for us because we don't actually, the first check's our only check. So it's not the case that, we've got to get this 200K check in because we then want to write a $1.5 million check later. So we would actually view that as a big win. So actually, when we look forward over the next 5 years, we think we're going to have a much higher percentage of companies where our round's the last round than we've had before. I'm not saying that's going to be the dominant solution, but that almost never happened before, and there was usually a small company. But I think we're starting to see some that could potentially be, these could be companies with some significant revenue, and they just opt to maybe do debt afterwards, or they grow profitably. Or maybe then there's lots of shades of gray. The next one up is like, all right, well, actually, these are companies that can get to 10 million plus of ARR, and maybe there's a round after us, but maybe there's just $1.5 million round or $2.5 million round, and then that's it, and the company can grow profitably. These just weren't very, those were the massive exceptions instead of the norm. And I think if we look forward in the software space and in a lot of areas over the next many years as this evolves, I think that's going to become more the norm. And I think you're going to have this universe where it's just expected that if you're a technology company, once you get over 5 million ARR and almost always over 10, you better be profitable, because companies, I think, will start to be valued on multiples of EBITDA much more at a much younger stage than they are now.
It is really fascinating to sort of think through those implications.
And it's scary as an investor to think about that. But on the flip side, if you get to a world where you have companies that are just, most tech companies with tens of millions of revenue are based on EBITDA, valuations might go down, but there's going to be such a larger active and liquid exit market because there's almost always buyers.
Yeah, they're going to get more predictable, and we might see very different forms of liquidity, right? We've really been trapped in this kind of stagnant M&A world for a while that seems to be changing slash, trying to go to IPO. And like, you have all kinds of interesting paths to liquidity if you actually have a multiple on 10 million in revenue.
Yeah. So if I had to guess, and again, guessing the future is always fraught with you're most likely going to be wrong. But my guess is looking many years down the road, we end up in a world where valuations are lower. EBITDA multiples are applied to a much wider range of business models and earlier than we're used to in the technology space and software space. And that's going to be a painful adjustment to get used to, but there's going to be such a more active and predictable exit market. And that's going to be better, so much better for entrepreneurs and for investors as well. So I think that's where we ultimately get, is my best guess. And I don't know how long it takes to get there, but we shall see.
Let's pivot a little bit to think about the founder perspective, right? So there are a lot of people, first, third, fourth time founders and builders that are out there trying to build something new right now. And they are thinking, I need some capital. I have to feed my family while I build. Maybe I just need, that 100,000, 200,000 check. How, what is the best way that they can position themselves to someone like you that maybe goes a click beneath, well, go show me customer traction? Is there something that you look for in a founder that's raising a 200K check from you that they can keep in the back of their mind and say, crap, that's my milestone, so that I know I can go pitch Dave and his team?
Yeah, I'll give the answer from the Dave Lambert right side capital perspective, and then I'll answer it briefly too from what I think for like most investors and outside of us what it is. So for us, we're a very quantitative, data-driven investment selection process. So there's not a lot you can do. It does not matter if you're being referred to me from a good friend, from my cousin, from you. You're just as likely to get a yes or a no from us as if you randomly fill out our form on our website. And the things that we look for are, what's your product? Is it, if it's just this basic wrapper, and it doesn't do any execution and it just helps with a simple workflow, we're not investing these days. But it's what's your ARR, what's your growth rate, how capital efficient are you, what's your price point, understanding the product and how AI safe it is. Those all go into it. But where I think that if you look at most investors that are writing 200K checks, they're either very small funds or they're angel investor. It's a round with multiple angel investors. It's the decision to invest is almost always psychology as much as anything else. And so people are investing in you, the founder, as much as they are in your specific business and product, or they're investing in your vision of the future. People are always buying your future as much as they're buying your present. And that's true, both when we invest at seed stage, at Series A. And so, you have to realize that you're selling your future as much as your present.
I feel like we need to be honest with ourselves and realize that you're also selling how, your future reflects on the people who made a bet on you, right? Like, speaking of psychology. And that's I don't know what to do with that exactly, but I think that's something that founders often forget when they think, okay, it's a purely algorithmic driven data driven decision.
Yeah. I think the hardest part that founders misunderstand, and I did it first. Someone sort of told me this, that I sort of had this aha moment in the mid 2000s when I was raising for my software company. But investors don't evaluate don't evaluate tech companies in a vacuum. Like, you feel as the founder, I'm talking to this investor, and my bar to get them to invest is for them to think I'm a good investment and they're going to make a good return off me. But it's actually not that. It's a pure marketplace. At any point in time, that investor is looking at lots of other companies, and you've got to be the cream of the crop. And you've got to be better than anything else that they're looking at that's at a similar valuation and a similar round size, that's also in your sector, all these things that are going on. And whether it's conscious or subconscious, you're getting compared to all these. You're competing against every other software company out there, or every other hardware company, or every other services, whatever profile your business model is. And you don't feel it. You're not aware of this. But that's what's going on. And just realize, to get a yes out of an investor that's a professional investor, the goal is you've got to look better than almost everything else they're thinking about investing in at that point in time. When you get to smaller check sizes and you get to angel investors, family, things like that, they don't have as much of a wide bandwidth, and they're not looking at it as much. And then it's, then the dynamic isn't just marketplace. It's maybe a little bit of marketplace and a lot more psychology. I mean, staying high level. And I think as a founder, didn't think about this and wasn't aware of it, but it helps you critically view yourself better.
Pay attention, founders. No, pay attention. This is gold. Well, all right, Dave. For the last little bit here, I want to cast back in time a little bit. I want to go back into the 90s. You were doing, if I understand correctly, IT services and value add reselling, and like you were deep in the IT world in the 90s. Is that right?
Yeah, so I started out right after college, started a computer hardware company. We basically would have been called like a PC clone maker at the time, is where we started, just selling retail. And then pretty quickly we pivoted and sold mostly corporate. And we sold a lot of the rack mount servers, high end workstations that a lot of the .com 1.0 companies used on their way up, and sold to a lot of the workforces, the computers on the desks. And then we almost went out of business when our customer base went out of business, or went from 800 employees to 120 in a year, things like that. Yeah. So that's the world I was in.
Okay, well, I want you to cast yourself back to the beginning of that journey, right? And I mean, I am from this era. I remember dial-up and ISDN. I remember BBSs. I remember a world where, everything we are living today was pure sci-fi. So if you put yourself in the Dave Lambert in the 90s, what would surprise you the most about the world we live in today, and what would not? What would you be like, yep, that was an inevitable outcome of the trajectory that I saw?
Oh, that's a really interesting question, because the one thing I've observed with technology over the years is there are always things that people think, oh, we're just a few years away from this. And then it ends up we're like 12 years or 15 years. And then there's things that come out of the blue that's, holy cow, this is science fiction. And I didn't see it coming. So like I remember in the early 90s, early to mid 90s, the amount of venture capital money that went into set top cable boxes. It was just this crazy, insane problem. How are you going to navigate through 500 channels, which was just right around the corner coming? And it turned out solving this problem, having a good UI and the technology for the box to work, everyone assumed that would be solved in 2 years. And it was like a decade plus that it took to do that. So I would have been shocked that that took so long. I think also there's this massive hype I remember at that time around what was called pin computing. There's this period where just hundreds of millions of dollars of VC capital was lit on fire. Everyone thought, oh, now that people can write and have these pads that pick up their signature, no one's going to want to use a keyboard, because we only use them because we have to. And there are all these visions of everything being, written and all of that. And the only thing that came out of that was the UPS signature pad, the little bar that you signed on the tablet that the UPS drivers had, and the point of sale thing. And every other view of where the world was going to go with that never materialized and just didn't make a difference. So like there's been so many things like that where I sort of bought into the hype and shocked, or how that nothing happened or it took longer. And then other things like, you know, smartphones, just coming out of the blue so quickly. And it's not like, it's not like they appeared and it took 15 years for them to have this crazy functionality. It was just so quick and so soon. I think even as hard as it's been for autonomous vehicles, and it's been much harder than anyone thought. So you'd asked me in the 90s, boy, I would have thought that's like, I wasn't just going to be 20 years away from seeing them all around San Francisco being tested out. I think certainly, and I mean, everyone who's on this, I think everyone can remember how blown away. I think it's almost sort of like, I remember where I was and what class I was in high school when the space shuttle blew up, right where you were. Like people in the 60s remember where they were when they found out that Kennedy died, or like when people landed on the moon, the good stuff too. And I think there's this ingrained period of time. I don't have a date, but like that first month when ChatGPT came out, or that first week when it was released to the world, and you could go into it and you could say, hey, write a story about this, as if you're a troll, and tell it from the perspective of a troll and with the wording that a troll would use. And it just did it perfectly. And it was just so mind-blowingly like, holy cow, how is this even possible? And that's just something that's ingrained in, I think, most people's psyche that first week there. Even I remember as a computer store in 1992, we opened up in July. We didn't have internet. We didn't have email. It was all just phone. Like I remember the magic of getting email for the first time, and holy cow, this instant communication, that seemed like science fiction. That seemed like Star Trek-ish at the time. It's just, yeah.
My first business, my quote unquote startup, but like I haven't told many people this, but like my first business that actually generated any money, and admittedly, I think I can measure it in 3 digits, but whatever, it was money, was a directory of bulletin boards with 800 numbers. So people could, for free, go on and communicate electronically. And that was a magic experience for people. And I actually distributed that directory through bulletin boards and eventually AOL. But like, you know, that was the world we live in. And but what's interesting to me is that is a world that predicted almost all of the things that we are experiencing today and still think will come in the future, but it got the timelines weirdly wrong. I love that actual framing. Like,
Yeah. There was so much right about the first .com bubble, like that blew up in everyone's face. Like there was this assumption that all that matters is the amount of eyeballs you get, and eventually people will figure out how to monetize them, and that will happen. And there'll be some huge winners there. And people were right, but people thought people would figure out how to monetize it in just a few years. And boy, even if you got to like the late 2000s, it was like Facebook and Google and not much more beyond that were monetizing them well. And eventually everyone learned how. So people were right, but they were just off by a generation, about how hard it would be.
and to your point, a lot of people lit a bunch of money on fire doing it, but that's okay because that investment, paid dividends. To Ben Thompson, we'll talk about all the money that put dark fiber in the ground that now we're using.
Yeah. Well, I can tell you from having lived in San Francisco during the first .com boom, we could fill up a 2-hour podcast episode just of crazy stories and like the insanity of like what people thought was a new reality, and just that looks just insane right now and what was happening. Yeah. So,
well, I got to tell you, to your point on not being able to predict timelines, I think for the last 15 years, because I've worked a bit in hardware myself, for the last 15 years, we've been about 3 years away from rollable displays and foldable OLEDs and all of that good stuff. And we're still 3 years away. But at some point, I blinked and didn't even notice. And the Turing test wasn't a thing anymore. And so it's wild.
Yeah. It's like it's going to be this novel bookmark in history. We once had this little period of time where we thought we needed this special test that was famous. I mean, just like we're going to look back at some point in history and we're just going to think it's insane that humans were allowed to drive cars, these like death traps on wheels, and like and it'll just seem insane. Just like it'll probably seem insane at some point in the future. People are going to look back and laugh. Hey, at one point, software engineer was this really high-paying, prestigious position, and they were way understaffed. And it's not 2 years from now we're going to look back, but if in 2080 we might look back and people will like think, oh, that's a bizarre, novel time in history.
Might be very different. Yeah. Well, it's exciting to be living through those times. Dave, thank you so much for coming on Innovators Inside. This has been a super fun conversation. We've covered a lot of ground. For people that want to follow your thoughts, where should they look? Do you post on LinkedIn? Should they head over to Right Side's website?
Yeah, mostly I'm posting on LinkedIn these days about sort of thoughts and trends that we see. If anyone wants to reach out to me, you can email me at dave@rightside.capital.com. I get a zillion emails a day, but hopefully I'll see it and can respond. And if you're interested in having us look at your startup, it's really the case that if you go to our website, you can look at what we invest in and the profiles. We need to update it to be more AI relevant. We'll probably be doing that in July. But if you fill out our pre-screening form, we do respond to everyone that fills that out.
Fantastic. Well, Dave Lambert, really appreciate you coming on Innovators Inside. I'm going to let you get back to the exciting chaos that is Silicon Valley these days.
Yeah.
I look forward to chatting with you next time.
Yeah, great. Thanks for having me on. It was a very fun discussion.